If you're among the investing throngs that's highly dissatisfied with today's low yields and suppressed rates, well, pay attention to what I've got for you. High yield strategies for income investors coming up next. Lance McGray from Advisors Asset Management joins me. Stick around. Welcome to ETF Guide TV. It's great to have all of you with us. I'm Ron DeLegge, and this is where we congregate on a regular basis to talk about investing strategies and things that can help you to get ahead. Now, we all know that dividends play such a critical role in total investment returns that we all get. Now, just for some perspective, almost half of the S&P 500's total return over the past 90 years is from dividend income alone. But in today's yield-starved climate, where can income investors still find a decent yield while limiting risk? Lance McGray, head of ETF product at Advisors Asset Management, is with us. Lance, good to see you again. Thanks for joining us.
Thanks for having me, Ron.
ETFs have experienced record asset flows in 2021, and your ETF lineup just crossed above $100 million in cumulative assets. Congratulations. That's a huge accomplishment. So what do you see as a contributing factor to the positive momentum?
Yeah, thanks again, Ron. And it's certainly, it's been a big few weeks for us here at Advisors Asset Management. As you mentioned, we did surpass the $100 million mark. And, even as a $35 billion asset manager, entering the highly competitive ETF landscape as a new ETF sponsor is challenging, to say the least. And we did just surpass that $100 million mark. And that's important for us here at Advisors Asset Management for a number of reasons. But most importantly, it validates our ability to provide income solutions which help investors meet their goals. Right? And this is something that we really set out to do back in 2017 when we got into the ETF market through our first product, SPDV. And it really still remains one of the major goals of us today is to provide additional products that help advisors, institutional asset managers, and even the retail audience solutions to meet their income goals. Currently, all of our ETFs, SPDV, DMDV, EEMD, and PFLD, all had 730 SEC yields greater than 328. So again, we're offering some very innovative products that are offering attractive valuations, elevated levels of income, and we're awfully excited about what's going to come here at Advisors Asset Management, specifically on the ETF front.
Let's focus our attention on one of the ETFs that you just mentioned, the AAM S&P 500 High Dividend Yield ETF. That's ticker symbol SPDV, which has delivered some impressive results. It's handsomely outperforming the regular S&P 500 on both a year-to-date and one-year basis. So what's the story behind SPDV's remarkable run?
Yeah, SPDV's, like as I said earlier, SPDV, the AAM S&P 500 High Dividend Value ETF, ticker SPDV, was the first product we launched back in 2017. And as you mentioned, its performance over the year-to-date and one-year performance numbers have been very, I would say, spectacular, 23% and 45% over those respective timeframes. So, really the performance here around SPDV and pretty much our entire high dividend value suite has really come on the heels of the economy crawling out of the global pandemic, right? And barring any setbacks created by the dangerous Delta variant, which is currently out there, we do expect growth to broaden out, which tends to favor stocks exhibiting attractive valuations. And that's exactly one of the major goals of our entire high dividend value lineup, including SPDV. So as a reminder, SPDV, we take a slightly different approach to dividend investing, and it has paid off over the last year. Whereas most dividend investors will do one of two things. One camp is that they reach for yield, so they are trying to achieve the highest yield possible through stocks. Obviously, we know the drawbacks of that. While you're creating elevated levels of yield, there is a tendency of having stocks that cut their dividend and obviously feel the pain of that from a price appreciation standpoint when they do cut their dividends. On the flip side, the other dividend camp, which we sort of modeled SPDV and our high dividend value lineup off of, is the camp of dividend investors that really focus on dividend sustainability. And those companies or those investment approaches look for sustainable dividend paying stocks. So not necessarily the higher yields, but looking specifically for companies that can maintain and, more importantly, grow their dividend over time. Now, these two dividend camps have historically sort of operated independently from each other. But what we try to do with the partnership with S&P on this high dividend value lineup is we try to incorporate these into one strategy. So not only are we offering the benefits of the additional yield seeking portfolio, but we also try to do it through mitigating the exposure to companies that may potentially cut their dividends. So we're looking for high dividend paying companies that also offer a sustainable dividend paying characteristics. And the question is, how do we do this? And it's not as complicated as you may think. What we try to do is we essentially select 5 securities from each of the gig sectors of companies that have the best combination of not only the highest dividend yield, but the highest free cash flow yield. So on one side of the spectrum, you're looking for that high yield portfolio, but on the other side, you're selecting securities that not only have a high dividend yield, but have a high cash flow yield. So they're generating positive cash flow. They most likely have the ability to maintain and grow those dividends, but they're also attractively priced as well. We take 5 securities from each sector that have the best characteristics from both dividend yield and free cash flow yield. We equally weight them and we rebalance them twice a year. And that's really in a nutshell how we tackle or how we attempt to achieve not only a high dividend yield, but also sustainable dividend paying stocks in the same portfolio.
Let's shift to Chinese stocks, which have gotten clobbered on concerns of new regulation that may restrict capital investment and growth. Ray Dalio authored a wonderful piece on LinkedIn all about China and understanding the recent moves. He urged investors not to abandon emerging markets or to let China's latest hiccups scare you away. So Advisors Asset Management has ticker symbol EEMD, which targets emerging markets. How has what's occurring in China right now changed or impacted EEMD's investment approach?
Yes, and to be honest with you, the short answer here is the underlying investment approach of EEMD. The investment approach has not changed, right? EEMD is a passively managed ETF which tracks, the companies within the S&P Emerging Markets Dividend and Free Cash Flow Yield Index. Now, again, just like SPDV, the main goal of EEMD is to provide exposure to stocks that exhibit both a high dividend yield and sustainable dividend distribution characteristics while maintaining that diversified sector exposure. Now, the article that you mentioned from Ray Dalio, I believe it was on LinkedIn, he talks about some of the recent crackdowns in the Chinese technology and education sectors, specific companies, and how those have sort of deterred investors away from China. But he also makes the case later on in the conversation in that piece is that these lockdowns these lockdowns are misunderstood, and that the exposure to China should also continue to be a major part of one's portfolio. So for your listeners out there, if they are thinking in line with Ray Dalio in terms of China being a very important part of one's allocation in their portfolio, EEMD offers a potentially a fantastic tool to gain that exposure. Now, unlike a lot of China-focused market cap ETFs out there, EEMD offers a few things that they necessarily don't offer. Number one, EEMD currently, as of the end of last month, had about a 24% allocation to China. So if you're sort of worried about China, but you also see the benefits of having equity exposure to stocks in China, you get that with EEMD along with other emerging market stocks. Also, you're getting a relatively high dividend yield. The 730 SEC yield for EEMD was 4.88%, which is very, very attractive in this low rate environment. That dividend is paid out on a monthly basis. And finally, you get the sector diversification that you get with all of our high dividend value stocks. You don't have to worry about having large concentrations in consumer discretionary or financial sectors as if you would invest in a China market cap weighted index. So you're getting sort of the best of both worlds. You're getting exposure to China. You're doing it in a fashion that's not necessarily giving you broad-based China exposure, and you're getting exposure to companies that not only offer a high dividend yield, but also offer dividend sustainability characteristics as well. So EEMD is a great potential tool for investors that are looking for exposure into China, but necessarily maybe still a little putting off by the recent crackdowns or lockdowns of the Chinese government.
One last thing before you take off, Lance. Yield-hungry investors don't necessarily need to take more risk by chasing stocks with high but unsustainable yields, nor do they need to pile into bonds with super long maturities of 20 or 30 years. On the other hand, preferred securities could be a good solution, and PFLD targets this group. Tell us more.
Yeah, and I couldn't agree with you more, right? Over the last decade, investors, many investors have sort of grown comfortable with reaching for yield through their equity allocation, especially in this low rate environment that we've seen for a number of years now. You know, unfortunately, historical volatility experienced in the equity market may be too much for income-seeking investors to stomach going forward. But on the flip side, harvesting, as you mentioned, meaningful income with the 10-year around 130 basis points right now is just not achievable. So where do we go? What can you do? And for this reason, as you mentioned, we are seeing a tremendous amount of pickup in interest in alternative asset classes, in particular preferred stocks, to help achieve these income goals of these yield-starved investors. Now, for those viewers out there that are not familiar with preferred stocks are hybrid securities which offer characteristics of both bonds and stocks. Now, some of the major benefits of these preferred securities is that they do offer higher yields because of where they fall in the capital stack. So yes, you are getting elevated levels of income. But one thing that's really worth noting is that it's not necessarily like you're investing in high yield bonds. If you think about PFLD, about 45% of the portfolio is invested in investment grade securities. So you're not dabbling down into high yield securities to get that elevated level of yield. On the flip side, you mentioned sort of taking on additional duration risk or investing in longer maturity bonds to gain additional yield. Obviously, that is one thing that you can do if you're looking for yield. But what we're seeing in this uncertain low rate environment with potentially the rates to move higher in the coming years is that a lot of investors are not willing to take on that risk. And that's one thing that really separates PFLD from its peers, is that PFLD is the only low duration preferred product out there. So when you compare PFLD to its broad-based preferred ETFs out there, which have durations greater than 4, the current duration, effective duration on PFLD is less than 1. So you're achieving a SEC yield of about 487 with a duration less than 1, which is very appealing for investors who are looking for a high yield with minimal interest rate risk.
Well, we're going to have to leave it there. Thank you so much, Lance, for your timely insights. Keep up the good work.
Thanks for having me, Ron.
Go to aamlive.com to learn more about AAM's lineup of dividend-focused ETFs. I'm Ron DeLegge with ETF Guide TV. Thanks for watching. We'll see you next time.